I've made millions in markets that screamed danger at me, and I've lost fortunes in markets that whispered safety. The single most expensive lesson I ever learned, and I learned it 3 times before it stuck, is this. When everything feels right, when the tape runs smooth as silk, when even the bootblack is giving you tips that work, when your last 5 trades closed in profit and you're starting to believe you've figured it out, that's not confirmation. That's the market setting the trap. The easiest money you ever made is the market's down payment on the hardest lesson you're about to receive. I'm going to show you why comfort in speculation is the most dangerous emotion you'll ever feel. You've been taught that confidence is the reward for doing the work, that when trading feels natural, it means you've finally developed your edge, that ease is evidence of skill. This is a lie, and it's the lie that separates professionals from corpses in this business. Most traders don't blow up during chaos. They blow up during clarity. They don't lose their capital when they're scared, they lose it when they're certain. You're watching your account grow, your win rate climb, and your confidence build, and you think you're on the path to mastery. You're not. You're on the path to maximum exposure right before the market changes character. And when it changes, you won't just lose your gains. You'll lose your belief in your ability to ever read the market again. I'm not going to teach you how to trade better in easy markets. I'm going to teach you why easy markets are the market's psychological weapon against you. This isn't about strategy or setups. This is about understanding that the market operates on a principle most traders never grasp. It rewards you just enough to make you reckless, then it takes everything you risked and everything you thought you'd learned. Every trading educator tells you to follow your system and manage your risk. I'm telling you something more fundamental. Your system doesn't protect you from yourself when the market makes following it feel unnecessary. The most dangerous moment in speculation isn't when you break your rules, it's when the market makes you believe your rules were overly cautious to begin with. Easy money isn't the market rewarding your skill. It's the market building your position size before it teaches you its hardest lessons. By the end of this, you won't fear chaos anymore. You'll fear comfort. I'm going to tell you about the time I absolutely knew that cotton was going higher, and how that certainty cost me more than any panic ever did. It was early 1908. Cotton had been in a strong uptrend for months. The fundamentals were perfect. Short crop, rising demand, inventory drawdowns that even the skeptics couldn't dispute. I'd built a substantial long position, and every single addition I made worked. The tape was clean. The price action was orderly. I'd wake up, check the opening, and see my position in profit before I'd finished my coffee. This is where the danger began. Not in the position, but in the feeling. I started to experience something I now recognize as the market's most effective sedative: rhythmic confirmation. Day after day, my judgment was validated. Not in explosive moves that might trigger caution, but in steady, reasonable, almost boring gains. 5 points up, consolidation, 6 points up, shallow pullback, 8 points up. The pattern was so reliable that I stopped questioning it. I didn't consciously abandon my rules. I still kept my stops, still checked the tape, but I had stopped being afraid. And in speculation, when you stop being afraid, you start being fully exposed. The ease of it changed my psychology in ways I didn't recognize at the time. I began adding to my position not based on new technical setups, but based on the assumption that the ease would continue. I was no longer trading the market, I was trading my recent experience of the plains market. And there is no faster way to ruin than that substitution. You see, the market doesn't exist to confirm your beliefs. It exists indifferent to them, but when it confirms them repeatedly, your brain begins to confuse correlation with causation. You think, I'm making money because I'm reading the market correctly. The truth is closer to, I'm making money because the market condition temporarily matches my method. Those are not the same thing. One is about you, the other is about conditions. And conditions change. I'd built my cotton position over 6 weeks. Started with a modest test position when the technical setup appeared clean. Added when price broke above a key resistance level. Added again when it pulled back to that level and held. Added once more when volume confirmed the trend continuation. Each add felt justified. Each add worked, and with each successful add, my confidence grew and my caution shrank. By week 6, I was carrying the largest position I'd held in months, and I felt good about it. Comfortable. Certain. Then the character changed. It wasn't a crash. It wasn't news. It was just a shift in the rhythm. Cotton stopped going up in that smooth, predictable way. It started chopping. My positions that had been in comfortable profit began giving back gains. Small losses appeared. Nothing catastrophic, just enough to make me uncomfortable. And because I'd built my position during the easy period, I was now holding maximum size during the difficult one. I was exposed. Fully. Completely exposed. And I didn't realize it until the damage was already done. Here's what happened next. Instead of recognizing the character change and reducing my position, I held on. Why? Because my recent experience told me that pullbacks were temporary. For 6 weeks, every dip had been a buying opportunity. Every moment of doubt had been wrong. So when cotton started chopping, my brain defaulted to the pattern it had learned. This is temporary. It'll resume. I've seen this before. Except I hadn't seen this before. What I'd seen before was a trending market experiencing shallow pullbacks. What I was seeing now was a market changing character from trend to chop. And I couldn't tell the difference because my recent wins had trained me to interpret all weakness as temporary. The chop continued for 3 weeks. Cotton would rally a few points, then give it back. Drop a few points, then recover. My position oscillated between small profit and small loss. I was stuck in what traders call no man's land. Not winning enough to feel good, not losing enough to force action. And all the while, the easy feeling was gone. The tape felt different, heavier, less certain. But I stayed in because I'd built the position when I was certain, and I couldn't admit that my certainty had been based on temporary conditions rather than permanent insight. Finally, cotton broke. Not dramatically, just a clean break below a support level that had held for weeks. And when it broke, I knew. I knew the way you know when you've been lying to yourself and reality finally forces you to stop. The trend was over. The condition that had made my position easy was gone, and I was holding maximum size in a market that was no longer cooperating. I got out. Not at the worst price, but bad enough. I gave back not just the gains from the last 3 weeks of chop, but chunks of the profit I'd built during the trend. When I tallied the damage, I'd lost more than 3 months of careful work and 3 weeks of stubborn hope. Here's what I learned. The easy phase isn't the market rewarding you. It's the market establishing your position. You think you're being smart by pyramiding into a winning trend. But what you're actually doing is accepting maximum exposure just before the conditions that made the trade easy disappear. The market doesn't trap you with fear. It traps you with comfort. It lets you win. It confirms your judgment. It makes you feel like you've figured something out. And just when you're fully committed, just when you've built your biggest position, your highest confidence, your deepest certainty, it changes. Not because it's malicious, not because it's trying to punish you, but because market conditions are temporary, and you mistook temporary for permanent. That cotton trade taught me something most speculators never learn until they're broke. The market doesn't kill you by being wrong. It kills you by being right, just long enough for you to bet everything on it staying right. And there's a specific psychological pattern that makes this trap almost unavoidable. Let me show you how it works. I once knew a speculator, I won't name him, but he ran one of the largest private trading operations in New York in the teens. Sharp man, cold nerves. He'd built his fortune on patience and discipline, 2 qualities you rarely see combined. But I watched him destroy himself in 6 weeks, and the cause wasn't greed or stupidity. It was ease. He'd caught a major move in railroads. His timing was perfect. Entered at the beginning of a substantial trend, scaled in at exactly the right points, and managed the position like a textbook case. For 2 months, everything worked. Not almost everything, everything. His entries, his exits, his position sizing, even his hedges. The man couldn't make a wrong move, and that's what killed him. Here's what happened to him psychologically. He started to believe that his recent win rate was predictive rather than descriptive. He looked at 8 consecutive winning trades and saw skill. What he should have seen was a market condition temporarily aligned with his approach, and market conditions always change. But he didn't see it that way. How could he? 8 straight wins, every decision validated, every moment of doubt proven wrong. His brain did what human brains do. It found a story to explain the success. And the story it found was, I've finally mastered this game. I've put in the work, learned the lessons, developed the instincts. This is what it looks like when a trader reaches the next level. It wasn't. What it looked like was a trader operating in ideal conditions for his method. Railroads were in a strong, clean uptrend. Volume was healthy. The market was rewarding momentum and punishing hesitation. His style, aggressive, trend-following, willing to add to winners, was perfectly suited to that environment. But he didn't think in those terms. He didn't think, my method works in trending environments. He thought, my method works, period. And that distinction, that failure to recognize that he was trading a condition rather than exercising a universal skill, set him up for destruction. The ease made him theoretical. He stopped watching the tape with the intensity of a man who knew he could be wrong. He started watching it with the confidence of a man who'd been proven right. And confidence, in speculation, is a leading indicator of upcoming loss. I could see it in him. He'd come into the office and talk about his positions the way a professor talks about a solved equation. No doubt. No hedging. No acknowledgement that the market might do something unexpected. Just certainty. And in speculation, certainty is delusion. The market is never certain. It's probabilistic. It's conditional. It's fluid. The moment you think you've got it figured out, you've stopped adapting. And when you stop adapting, you start dying. When the railroad move matured and the character changed, he didn't reduce his exposure. He added to it. Why? Because the previous 2 months had trained him to believe that pullbacks were buying opportunities. He'd been conditioned by success to see every dip as temporary, and he was right until he wasn't. The first dip after the character change looked just like the previous dips that had been buyable. Same technical setup, same volume patterns, same price action. So he bought it. The difference was the context. The previous dips had occurred in a healthy uptrend. This dip was occurring at the end of a mature move, in a market that was starting to lose momentum. But he couldn't see the difference because his recent experience had trained him to see all dips the same way. The railroad position went against him. Not dramatically at first, just enough to be uncomfortable. He held on. The market rallied a bit, and he felt vindicated. See? Just another dip. But then it rolled over again, this time harder. He held on again. Why? Because selling would mean admitting he'd been wrong, and his recent experience had taught him that moments of doubt were usually wrong. For 2 months, every time he'd felt uncertain, the market had proven his uncertainty unjustified. So when he felt uncertain now, he assumed it was the same pattern, temporary doubt before the inevitable continuation. Except this wasn't a continuation. This was a reversal. And by the time he accepted that, the damage was catastrophic. The market didn't crash. It just stopped cooperating. His positions went from profit to break-even, then from break-even to small loss, then from small loss to the kind of loss that makes you question whether you ever understood the game. He held on because his recent experience told him to. And recent experience is the worst teacher in speculation because it's always teaching you lessons about conditions that have already changed. By the time he admitted the trend was over, his equity curve looked like a man who'd learned nothing in 20 years. One smooth, beautiful rise, then a vertical drop that gave back not just the railroad gains, but chunks of capital from years prior. I had lunch with him after he'd closed out. He looked haunted, not by the loss itself, but by the realization that he hadn't seen it coming. A man who'd spent 20 years in the market, who'd built a fortune from nothing, who understood risk and probability and price action, and he'd walked straight into a trap that any beginner could have identified in hindsight. How does that happen? How does a professional speculator with decades of experience make such an obvious mistake? I'll tell you how. Ease. Ease is the most dangerous drug in speculation because it doesn't feel dangerous. It feels like validation. When you're making money easily, every part of your brain is telling you that you're doing something right. And you're doing something right for the current condition. But your brain doesn't make that distinction. It just registers. I'm winning. And winning feels like proof. Proof that you've figured it out. Proof that your method works. Proof that you're in control. And once you believe you're in control, you stop watching for the signs that control is an illusion. He told me something over that lunch that I've never forgotten. He said, "I thought I'd finally figured it out." Those words, "I thought I'd finally figured it out," is the epitaph of more trading careers than any other. It's what you think right before the market shows you that figuring it out is impossible, and the best you can do is stay flexible enough to survive when conditions change. You can't figure out the market. You can only learn to recognize conditions and match your behavior to them. And the moment you think you've moved beyond that, the moment you think you've transcended conditions and developed some kind of universal edge, you're finished. You just don't know it yet. These aren't stories about bad traders. These are stories about good traders who made one psychological mistake. They interpreted ease as evidence rather than as bait. And that mistake follows a pattern that's been destroying speculators since markets existed. Let me break down why your brain betrays you exactly when you think you've mastered the game. When you're making money easily, you're not safe. You're exposed. This is the central paradox of speculation, and it's the one lesson most traders never internalize. They think, "I'm trading. Well, therefore I'm in control." Wrong. When trading feels easy, what's actually happening is this. Current market conditions are temporarily aligned with your method, your temperament, and your time frame. That alignment is not permanent. It's not even likely to last. And the easier it feels, the closer you are to the end of that alignment. Here's why. Markets move in phases: trending phases, chopping phases, volatile phases, compressed phases. Your method works in some of these phases and fails in others. When you hit a phase where your method works, you win. You win again. You win a third time. And your brain, your stupid, pattern-seeking, dopamine-drunk brain begins to form a belief. I've figured this out. You haven't. What you've figured out is how to trade one specific phase. And phases end. The market doesn't announce the phase change. There's no bell, no headline, no press release from the exchange saying, "Attention traders, the trending phase is now complete, and we're entering a chopping phase. Please adjust your methods accordingly." It just changes. The trend that's been rewarding you for weeks just stops. And when it stops, you're holding maximum size because the easy period convinced you to add. You're mentally conditioned to buy dips because dips kept working. You're fully committed at precisely the moment when commitment becomes catastrophic. I've seen this pattern destroy more careers than bad risk management. Because bad risk management is a technical error, you can fix it. You learn to use stops. You learn to size positions appropriately. You learn not to risk more than 1 or 2% on any single trade. Those are teachable, fixable problems. But believing ease equals mastery, that's a psychological error. And those are almost impossible to fix because they feel true. They feel earned. You're not being reckless, you're operating from confidence built on real results. You're not gambling, you're scaling up after proving your method works. Everything feels justified. Everything feels rational. And that's why it's so deadly. Let me be explicit. If your last 10 trades worked, you are not a better trader than you were when your last 10 trades failed. You're just trading in a market condition suited to your approach. And market conditions change faster than your psychology can adapt. Your brain needs time to unlearn patterns. It needs repeated evidence that the old pattern no longer works before it'll abandon the behavior that pattern created. But the market doesn't give you that time. It changes character in days or hours, and if you're still operating on the lessons learned in the previous phase, you're trading against the current reality. The professional speculator knows this. When things are working, he doesn't celebrate, he tightens. He reduces size. He becomes more cautious, not less. Why? Because he knows the easy money is the market's way of building his exposure before it changes the rules. He knows that every winning streak is temporary. He knows that the market that's been rewarding his behavior will eventually punish it, and the transition won't be obvious until it's too late. So he does what seems irrational to the amateur. He becomes more conservative as his recent results improve. He takes profits earlier. He passes on setups that look good. He holds more cash, not because he's scared, but because he understands that ease is a lagging indicator, not a leading one. By the time trading feels easy, you're already closer to the end of the favorable phase than the beginning. So if ease is dangerous, what should you actually feel when you're trading well? Let me tell you what real mastery looks like, and why it's nothing like what you've been taught. Real mastery doesn't feel like confidence. It feels like vigilance. It feels like perpetual uncertainty held in check by discipline. The truly skilled speculator is always asking, is this me, or is this the market? Is my method working because I'm executing it well, or because current conditions happen to favor it? And if he can't answer that question with precision, he doesn't increase his risk. He maintains it or reduces it. I learned this after years of making the same mistake in different forms. I'd have a great quarter, 10, 15 consecutive winners, account up 30, 40, 50%, and I'd feel invincible, like I'd finally broken through to some higher level of understanding. Then I'd hit a string of losses that would give back half those gains in a third of the time. And every time, I'd be blindsided. Every time, I'd wonder how I didn't see it coming. And every time, the answer was the same. I'd mistaken temporary alignment for permanent skill. The shift came when I started keeping what I called a condition journal. After every trade win or lose, I'd write down not just what I did, but what the market was doing. Was it trending or chopping? Was volatility high or low? Was volume healthy or weak? Was the broader market in a risk-on or risk-off mood? I forced myself to describe the context, not just the trade. And after 6 months of this, a pattern emerged that changed everything. My wins clustered around specific conditions, and my losses clustered around different conditions. I wasn't a good trader having random bad luck. I was a conditional trader trying to operate unconditionally. Once I saw that, I couldn't unsee it. I realized that roughly 70% of my profits came from about 30% of my trades, and those trades all occurred during the same type of market condition. Clean trends, healthy volume, low volatility. When those conditions were present, my method worked beautifully. When they weren't, I was essentially gambling, not because I was executing poorly, but because I was trying to force a trend-following method into a market that wasn't trending. The losses weren't bad luck. They were inevitable. I was using a screwdriver to hammer a nail, and wondering why it wasn't working. Most traders can't distinguish between their skill and the market's temporary cooperation. This confusion is lethal. When you make money, you attribute it to skill. When you lose money, you attribute it to bad luck or a weird market. This is not just wrong, it's backwards. The truth is closer to this. When you make money easily, it's because the market condition matched your method. When you lose money, it's often because you kept applying that method after the condition changed. Real skill isn't making money when the market cooperates. A monkey can do that. Put a monkey in front of a screen during a raging bull market with a button that says buy, and the monkey will make money. That's not skill, that's condition. Real skill is recognizing when the market has stopped cooperating and getting out before you give back your gains. Real skill is the ability to distinguish between I'm trading well and the market is easy. And almost no one develops that ability because it requires you to doubt yourself at exactly the moment when you feel most confident. Here's the test. If you can't articulate exactly why your method worked during your winning streak, then you don't actually know why you won. And if you don't know why you won, you won't know when to stop trading that way. Let me give you a concrete example. Say you're a breakout trader. You buy stocks that break above resistance with volume. For 3 months, this works beautifully. Every breakout you take runs. Your win rate is 80%. You're making money so consistently you start thinking about quitting your job. You start telling friends you've figured out a system. You start believing that you've discovered some edge that other traders are missing. What you don't realize, you're in a trending, momentum-driven market phase. Breakouts work because there's institutional buying pressure, retail enthusiasm, and low volatility. Those conditions are creating your edge, not your ability to disc in spot breakouts. Any trader with a basic understanding of support and resistance could make money in that environment. The edge isn't in your pattern recognition. The edge is in the market condition. But you can't see that because you're focused on your execution, your discipline, your growing account balance. You think, I'm killing it. The truth is, the market is cooperating with your method, and you're mistaking cooperation for competence. Then the market shifts. Volatility picks up. Institutional money gets cautious. Retail enthusiasm wanes. The trending, momentum-driven environment disappears, replaced by a choppy, news-driven, mean-reverting market. Breakouts start failing. Instead of running, they pop and drop. Your 80% win rate becomes 40%. Your account that was up 30% over 3 months gives back 15% in 3 weeks. And because you attributed your previous success to your skill at identifying breakouts, you keep trading them. You think, I just need to be more selective. So you look harder, apply more filters, trade smaller size, but you're still trading breakouts in a market that's no longer rewarding breakout behavior. The professional would have recognized the condition change and stopped. Not because he's smarter or more disciplined, but because he's trained himself to think in terms of conditions rather than conviction. He doesn't ask, is this a good breakout? He asks, is this a market that's rewarding breakout behavior? And if the answer is no, he doesn't trade. He waits. He sits in cash. He watches. And he doesn't feel like he's missing out because he understands that missing out on losses is the most profitable thing you can do in speculation. The amateur keeps refining his method, convinced that if he just finds the right setup, it'll start working again. It won't. Because the problem isn't your execution, it's the environment. You can't fix an environmental problem with better execution. It's like trying to grow tomatoes in winter by watering them more carefully. The water isn't the issue. The season is the issue. And no amount of careful watering will change the season. This brings me to the question every struggling trader asks, and almost no one answers honestly. How do you actually know when the market has changed character? Let me give you the real answer, not the textbook one. The market always warns you. Always. But you have to be paying attention, and you can't be paying attention if you're drunk on recent success. When I was young, I thought reading the tape meant predicting the next move. I was wrong. Reading the tape means recognizing when the current pattern has stopped working. It's not about being right, it's about noticing when you're starting to be wrong before the damage compounds. Here's what change looks like. The rhythm shifts. Moves that used to take 2 days now take 2 hours. Or moves that used to take 2 hours now take 2 days. The timing is off. You enter the same setups that worked last week, but now they chop you out. Your stops get hit more frequently. Your winners don't run as far. The tape feels different, heavier if the character is shifting bearish, more erratic if volatility is increasing, sluggish if momentum is dying. This is the market telling you the condition has changed. But if you're trading from confidence instead of observation, you don't hear it. You explain it away. Just a weird day. Probably some news I missed. I'll get back on track tomorrow. And you keep trading the same way, convinced that your recent success is proof your method works, when what it actually proved is that your method worked in a specific condition that no longer exists. The losses start small. A couple of quick stop-outs. A winner that doesn't run as far as expected. Nothing dramatic. Nothing that screams, you're in the wrong environment, get out now. Just subtle degradation in your results. And because it's subtle, you ignore it. You tell yourself. Every trader goes through cold streaks. This is normal variance. I just need to stay disciplined and work through it. But it's not variance. It's signal. The market is signaling that the condition your method requires is gone. And the longer you ignore that signal, the more damage you do. Because you're not just losing money, you're training your brain to doubt your method in all conditions. You're teaching yourself that following your rules doesn't work. And once you lose faith in your method, you start freelancing. You start taking trades that don't meet your criteria because your criteria stopped working. You start exiting winners early because you've been conditioned by recent failure to expect every move to reverse. Your discipline erodes. Your confidence collapses. And what started as a simple environmental mismatch becomes a full-blown psychological crisis. I've trained myself to do something most speculators find impossible. I've trained myself to become more skeptical of my method when it's working, not less. When I'm winning, I ask, is this me, or is this the market? And if I can't answer that question with specificity, I reduce my size. I don't add. I don't celebrate. I don't let myself believe I've figured anything out. I just tighten my stops, take some profits, and watch to see if the condition persists or changes. This feels unnatural. It feels like I'm capping my upside. It feels like fear masquerading as discipline. It's not. It's the only rational response to the reality that market conditions are temporary and my ability to identify when they've changed is imperfect. Here's the practice. After every winning trade, write down exactly why it worked. Not, I bought the breakout, that's not specific enough. Right. I bought the breakout because the market was in a low volatility uptrend with institutional accumulation and retail momentum. and those conditions made breakouts likely to follow through. Then, before your next trade, ask, are those conditions still present? If you can't answer yes with confidence, don't take the trade, or take it with half size, or take it as a test position to see if the condition has truly changed. This practice will feel like a brake on your momentum. That's the point. Momentum in speculation is dangerous. What you want is consistency, and consistency comes from matching your method to the current condition, not from believing your method works in all conditions. The best traders I've known aren't the ones who make the most money when they're hot. They're the ones who lose the least when they're cold. They're the ones who can sit in cash for weeks waiting for their condition to return. They're the ones who don't confuse activity with productivity. And they all share one trait. They're more afraid when they're winning than when they're losing. Now let me address the thought I know is forming in your mind. If I have to be this cautious when I'm winning, how do I ever build significant capital? That's the right question. And the answer is going to challenge everything you believe about position sizing. There's a right way and a wrong way to add to a winning position. The difference determines whether you build a fortune or lose one. The wrong way, you're in profit. The position feels good, and you add because you want to maximize your gains. This is hope disguised as strategy. You're adding because you're comfortable, not because the market is giving you a new signal. You're adding based on emotion, the emotion of wanting to make more money, rather than on evidence that the move has more to go. This is how most traders turn good trades into disasters. They catch a move. They're up 20% on the position. It feels great. They think, if I'm making this much on a half position, imagine what I'd make on a full position. So they add. And what happens? The market tops out right after they add, because they added based on their desire for more profit rather than on the market's willingness to deliver more profit. The right way. You're in profit. The market gives you a new technical entry point, and you add only if your risk on the new piece is defined and small relative to the profit you're already protecting. This is strategy. You're adding because the market condition remains favorable and you can afford to test it with house money. The key distinction is this. When you add correctly, each new piece of the position is independent. It has its own entry, its own stop, its own risk profile. If the market changes and stops you out of the new piece, you still have your original position and its profit. You've risked a small percentage of your gain to test whether the move has more to go. When you add incorrectly, you're just making your existing bet bigger. You're not layering in based on new information. You're doubling down on your current belief. And if the market changes, you don't have layered protection. You have one giant position that all gets hurt at once. The original piece that was safely in profit is now at risk because you added more at a worse price. The whole thing becomes one big binary bet. Either the market keeps going your way and you make a lot, or it reverses and you give back everything. I learned this in wheat. I'd caught the beginning of a major move, got in clean, watched it run, took some profit, then added back when the market pulled back to support and resumed. Each add was smaller than the last. Each had a tighter stop. By the time I had my full pyramid built, I had 5 different entry points, each with its own exit strategy. My first position, the one I'd taken at the start of the move, had the most room. It was up significant profit and had a stop that would lock in gains even if the market reversed hard. My second position had less room but was still profitable. My third, fourth, and fifth positions were smaller and had much tighter stops because I was testing whether the move had more to go, not betting that it did. When the move matured and the market started to chop, my stops took me out in pieces. I gave back some profit, but I kept the majority because my earliest positions, the ones with the most gain, were protected by the tightest stops. I didn't ride the whole thing down because I hadn't built one giant bet. I'd built a layered structure that could be dismantled as conditions changed. The market took me out of my most recent adds. First, the ones I'd put on as tests. Those were small losses against the larger profits I'd already locked in. Then it took out my middle positions. Still profitable, but less so. My earliest position, the core of the trade, stayed on longest because it had the most breathing room. By the time that got stopped out, I'd captured the majority of the move and given back only what I'd risked on the tests. Compare that to the wrong way. You catch the move, you're up big, you add at the top because you're excited, and when the market turns, you're holding maximum size at the worst possible price. You give back everything not because you were wrong, but because you built your biggest bet at the end of the move instead of the beginning. You pyramided backwards. You let ease convince you to press at exactly the moment when pressing was most dangerous. This connects directly to the most misunderstood concept in speculation, the one thing that separates professionals from gamblers, and it's something I violated repeatedly until it nearly destroyed me. Let me explain why position sizing matters more than entry timing. You can't make money if you're out of the game. This sounds obvious. It's not. Most traders think the goal is to maximize returns. Wrong. The goal is to stay in the game long enough to catch the moves that matter. And staying in the game means preserving capital during the periods when your method doesn't work. Here's the math that ruins people. If you lose 50% of your capital, you need a 100% return just to get back to even. Not 50%, 100%. The more you lose, the harder it becomes to recover. Lose 70%, and you need a 233% gain to recover. Lose 80%, and you need a 400% gain. This is why blowing up isn't just painful, it's often permanent. Most traders who lose 70 or 80% of their capital never come back, not because they can't trade, but because the psychological and mathematical hole is too deep. The math doesn't work, and even if they could make the returns needed to recover, they can't execute them because the psychological damage from the drawdown has destroyed their ability to take risk. So when I say preservation matters more than returns, I'm not being conservative. I'm being mathematical. The trader who makes 10% a year for 10 years ends up wealthier than the trader who makes 50% one year and loses 30% the next. Consistency compounds. Volatility destroys. But here's the problem. Preservation feels like losing. When the market is running and everyone around you is making money, sitting in cash feels like you're missing out. It feels like cowardice. It feels like you're letting fear control you. You're not. You're recognizing that the current market condition doesn't match your method, and rather than force trades that are likely to lose, you're waiting for conditions to shift back in your favor. This is not fear. This is discipline. I've sat out of markets for months, not because I didn't have ideas, but because the tape was telling me that the market was in a condition where my ideas were likely to fail. And every time I've done this, every single time I've watched other traders blow up trying to force action in a market that wasn't offering clean opportunities. They couldn't sit still. They needed to feel like they were doing something. They needed to be in the game. So they took marginal setups, forced trades in choppy conditions, convinced themselves that this time would be different, and they got carved up. Not because they were bad traders, but because they were trading in an environment that didn't suit their method, and they couldn't accept that doing nothing was the right play. Then, when the conditions shifted and my method started working again, I still had capital to deploy. I could take full position sizes in the good setups because I hadn't bled myself out taking half setups in the bad environment. I hadn't trained myself to doubt my method by watching it fail repeatedly in the wrong conditions. I came back fresh, with capital and confidence intact, ready to trade when trading made sense. The traders who couldn't sit still, they came back wounded, smaller accounts, damaged confidence, doubt about whether their method ever worked, and that doubt made them hesitant when they should have been aggressive, which meant they missed the moves that could have helped them recover. Here's the practice. Track your trades by market condition, not just by win rate. After 6 months, you'll see a pattern. You make money in certain conditions and lose money in others. Once you see this, the solution becomes obvious. Trade more in the conditions where you win, and trade less or not at all in the conditions where you lose. This requires honesty. Most traders lie to themselves. They blame their losses on bad execution or bad luck, when the real cause is that they were trading in the wrong environment. If you can admit that your method doesn't work in all conditions, you can stop trading it when those conditions are present. And that admission that your method has limits is the beginning of professional speculation. Everything I've told you so far leads to one unavoidable conclusion, and it's the conclusion most traders spend their entire careers avoiding. Let me spell it out. The market doesn't care about your opinion, it only cares about position and price. You can be right about direction and still lose money. You can be wrong about direction and still make money. How? Position size and timing. I've been right about the major trend in a stock and lost money because I was too early and my position was too large. The market eventually went where I thought it would, but my stops took me out before it got there. I was right. I lost. And that's the game. Conversely, I've been dead wrong about where a market was headed, but because I entered small, used tight stops, and exited fast when I realized I was wrong, I lost almost nothing. Then I flipped my position and caught the real move. I was wrong. I won. And that's also the game. Your opinion about the market is worthless. The only things that matter are where you're positioned, how much you're risking, how quickly you can adapt when you're wrong. Most traders get this backwards. They spend all their time forming opinions, analyzing charts, reading news, listening to experts, and almost no time managing their actual exposure. Then they wonder why they keep losing money, even though they knew what the market was going to do. Knowing is not trading. Trading is execution under uncertainty. And execution means making decisions about size, entry, exit, and risk in real time, based on incomplete information, with your capital at stake. It means being wrong and losing small. It means being right and making big. It means recognizing within minutes or hours whether a trade is working and acting on that recognition without attachment to your original idea. Most traders can't do this because they confuse their opinion with their position. They think, I believe this stock is going higher, therefore I must hold it. Wrong. You hold it only as long as the market is confirming your belief. The moment it stops confirming, you exit. Doesn't matter what you believe. Doesn't matter what the fundamentals say. Doesn't matter what your analysis suggests. The market is telling you you're wrong, and in speculation, the market is always right. Here's what this looks like in practice. I see a setup I like. I enter small, say 25% of my intended full position. Why? Because I don't know yet if this setup is going to work. The market might look perfect on the chart, but the tape might tell a different story once I'm in. So I test it with a small piece. If the position immediately goes my way, and the tape confirms my read, I add. Not because I'm more confident, but because the market is rewarding my entry and giving me new technical confirmation. If the position chops or goes against me, I exit. Fast. I don't wait to see if I'm right. I don't give it more room. I recognize that the market isn't confirming my read, and I get out with a small loss. This approach infuriates most traders because it requires admitting you don't know in advance whether a trade will work. They want certainty. They want to enter full size because they know the trade is good. But you don't know. You think you know. And the difference between thinking and knowing is your capital. The market doesn't care what you think. It's going to do what it's going to do, and your job is to respond to what it does, not to impose your will on it. This is the hardest lesson in speculation because it requires killing your ego. Your ego wants to be right. It wants to predict. It wants to prove it figured something out. But the market doesn't reward ego. It rewards adaptation. So, here's where we arrive at the hardest truth of all, the one that finally made me a consistently profitable trader after years of boom and bust. It's going to sound simple, but living it is almost impossible. Waiting is the trade action is often just anxiety disguised as work. The hardest thing a speculator will ever do is nothing. You're watching the market. You have capital. You have ideas. The tape is moving. Other traders are making money. And you're sitting there, doing nothing, because the right setup hasn't appeared. This feels unbearable. It feels like you're wasting time. It feels like you're not trading. You are trading. You're trading by not trading. You're preserving capital, avoiding bad setups, and waiting for the market to give you an opportunity where your edge is clear. This is the trade. But your brain fights you. It says, you should be doing something. Everyone else is. You're missing out. And so you take a marginal setup just to feel like you're participating. And that marginal setup loses. Not because you're a bad trader, but because you traded to satisfy your need for action rather than waiting for the market to offer you a genuine opportunity. I've made this mistake hundreds of times. I'd go weeks with no clean setups, feel restless, take a pretty good trade just to be in the game, and lose money. Then, 2 days later, the clean setup I'd been waiting for would appear, but I'd already lost capital on the impatient trade, so I had less to deploy when the real opportunity came. The pattern is always the same. Impatience leads to suboptimal trades. Suboptimal trades lead to small losses. Small losses lead to reduced capital. Reduced capital leads to missing the big opportunity when it finally appears. Here's what changed for me. I stopped measuring my success by how many trades I made. I started measuring it by how many bad trades I avoided, and once I made that shift, my results transformed. Not because I got better at picking entries, but because I stopped taking entries that were only okay. I waited for setups that were clean. I waited for conditions that favored my method, and I accepted that sometimes that meant doing nothing for days or weeks. The professional speculator understands that markets don't offer opportunities on your schedule. They offer them on their schedule. And your job is to be ready when they arrive, not to force them into existence when they don't. Money is made sitting, not trading. I know that sounds absurd. How do you make money by not trading? Because you're avoiding the losses that most traders take while they're trying to make money. The average trader makes 10 trades, 6 losers that cost him 15%, 4 winners that make him 20%. Net, he's up 5%, but he's stressed, exhausted, and he's given back most of his gains to commissions and emotional energy. The professional makes 3 trades, 1 loser that costs him 2%, 2 winners that make him 20% each. Net, he's up 38%, and he spent most of his time doing nothing. Same market, different results. The difference is patience. But patience is not passive. It's active waiting. It's watching the tape every day. It's staying aware of conditions. It's knowing what your setup looks like and being ready to act when it appears. It's the opposite of hope. Hope is, I don't know what I'm waiting for, but I'm hoping something good happens. Patience is, I know exactly what I'm waiting for, and I'm prepared to act the moment I see it. Most traders confuse the two. They think they're being patient when they're actually just being passive. They're not waiting for specific conditions, they're just not trading because they're scared or uncertain. That's not patience. That's paralysis. True patience comes from clarity, when you know what your edge is, when you know what conditions create that edge, and when you know what those conditions look like on the tape. You can wait without anxiety. You're not missing out. You're just waiting for your game. You're a lion on the savannah. You don't chase every antelope. You watch. You conserve energy. And when the right opportunity appears, the weak one, the isolated one, the one you know you can catch, you strike. Fast, decisive, committed. And then you return to watching. This is how professionals trade. They spend 90% of their time watching and 10% executing. Amateurs spend 90% of their time executing and 10% watching. The amateur is always in the market, always taking trades, always active. He thinks that's what trading is, constant action. The professional knows that's what losing is. Constant action in speculation is constant bleeding. 1,000 small cuts from marginal trades, forced entries, impatient exits. The professional makes a few big trades a year and spends the rest of his time waiting for them to set up. Now, here's where most traders get stuck. They understand intellectually that patience is important. They've heard it from every trading book, every mentor, every experienced speculator, but they can't live it. They can't sit in cash while the market moves without them. They can't watch other traders make money and stay disciplined. They know they should wait, but they can't. And the reason they can't is because they don't know what they're waiting for. They don't have a clear definition of their edge. They don't have a specific description of the conditions where their method works. So they're just waiting in general, hoping something will look good. And that's not patience, that's torture. Here's how to fix it. Write down, in specific detail, what your ideal setup looks like. Not in general terms, in specific, observable, testable terms. Not I wait for good breakouts. That's useless. Write, I wait for stocks that are in clean-up trends on the daily chart, that have consolidated for at least 5 days, forming a tight range, that are breaking above that range on volume at least 50% above average, during a market environment where the broad indices are in confirmed uptrends and volatility is below 20. That's specific. That's testable. And now you know what you're waiting for. You're not just sitting in cash hoping something good happens. You're watching for a specific pattern in a specific context. And when you see it, you act. When you don't see it, you don't trade. This level of specificity does 2 things. First, it makes waiting easier because you're not anxiously wondering if you're missing opportunities. You're calmly observing whether your specific conditions are present. Second, it makes you better because you're only trading in the conditions where your method actually works. You're not taking breakouts in choppy markets or low-volume environments and wondering why they fail. You're only taking them when the conditions are right. And that means your win rate goes up, your confidence increases, and your patience gets reinforced by results. But here's the paradox. The more specific you are about your edge, the less you trade. And the less you trade, the more selective you become. And the more selective you become, the better your results. This feels backwards. It feels like you're limiting yourself. You're not. You're focusing yourself. You're trading only when you have an edge, and an edge by definition is rare. If opportunities appeared constantly, they wouldn't be opportunities, they'd be guaranteed. And there are no guarantees in speculation. There are only probabilities that shift based on conditions. Your job is to recognize when those probabilities tilt in your favor, and to bet aggressively when they do. The rest of the time, you wait. Let me tell you what happened when I finally internalized this. I'd spent years trading constantly, always in the market, always positioned, always looking for the next move. My results were erratic. Big wins followed by big losses. I'd build my account, then give it back. The cycle repeated for years, and I couldn't figure out why. I knew the principles. I knew about risk management and patience and discipline, but I couldn't make it work consistently. Then I started tracking my trades by condition, and the pattern became obvious. I made all my money in about 20% of my trades. The other 80% were noise. Small wins, small losses, break-evens. They added nothing to my bottom line, but they added enormous stress, consumed massive amounts of time and energy, and most importantly, they kept me from having capital available when the real opportunities appeared. So I made a decision. I would only trade my A-plus setups. If a trade didn't meet every single criterion I'd defined as ideal, I wouldn't take it. Didn't matter how good it looked in general. If it wasn't perfect by my specific definition, I passed. The first month was agony. I watched dozens of trades I would have normally taken. Some worked, some didn't. I felt like I was being too conservative. I felt like I was letting opportunities slip away. But I held firm. Second month, same thing. Fewer trades I wanted to take, but still several I passed on. Then, in the third month, I got my first A-plus setup. Perfect trend, perfect consolidation, perfect breakout, perfect volume, perfect market context. I took it, full size, and it ran. Made more in that one trade than I'd made in the previous 3 months combined when I was trading constantly. That's when it clicked. I didn't need to trade all the time. I needed to trade perfectly when the perfect setup appeared. And to do that, I needed to conserve capital and energy during all the times when perfection wasn't available. Over the next year, I took fewer trades than I'd taken in any single month during my years of constant trading, and I made more money than I'd made in any previous year. Not because I got better at trading, but because I got better at not trading. I stopped giving back my gains in marginal trades. I stopped bleeding capital in environments that didn't suit my method. I stopped exhausting myself trying to force opportunities that didn't exist. The market is generous, but only if you're patient enough to wait for its generosity. It will give you opportunities. Not every day, not every week, sometimes not every month, but when it gives them to you, they're obvious. They're clean. They're the trades where you risk small and make big, where you get in early and ride the whole move, where you execute with confidence because every part of your analysis is screaming, this is it. Those trades make careers. Those trades build fortunes. And you only get them if you're not wasting capital and energy on all the trades that aren't them. So if you take nothing else from this, take this. When the market feels easy, that's when you tighten up. When your trades are working, that's when you become more cautious. When you're winning, that's when you prepare for conditions to change. Because the market that rewards you today will punish you tomorrow, and the transition won't announce itself. You'll only realize the condition changed after you've given back gains. Unless you've trained yourself to recognize ease as a warning signal rather than a confirmation signal. The traders who survive aren't the ones who make the most during good times. They're the ones who lose the least during bad times. They're the ones who can sit in cash without anxiety. They're the ones who reduce size when they're winning instead of pressing harder. They're the ones who understand that their job is not to maximize every opportunity, but to preserve capital and deploy it optimally when conditions are truly favorable. These are not exciting principles. They don't make for good stories. They don't feel like the path to wealth. But they are. They're the only path that works consistently over time. You're not in this game to hit home runs. You're in it to compound small edges over years. And compounding requires staying in the game. You can't compound if you blow up. You can't stay in the game if you confuse easy markets with skill. You can't survive if you let winning streaks convince you that you've transcended the need for discipline and patience. The market will always humble you. The only question is whether you'll learn the lesson early, when the cost is manageable, or late, when the cost is catastrophic. I've paid for these lessons in blood and treasure. I've lost fortunes, because I thought I'd figured it out. I've watched brilliant traders destroy themselves because they couldn't distinguish between their skill and favorable conditions. I've seen the wreckage that comes from confusing ease with mastery. And I'm telling you now, before you pay the same price, when trading feels easy, you're not safe. You're exposed. Tighten up, reduce risk, take profits, prepare for conditions to change, and whatever you do, don't let comfort convince you that you've figured out a game that can't be figured out. The market doesn't get figured out. It gets survived. And survival requires recognizing that the most dangerous moment in speculation is when you feel invincible. You're not broken. You've just been misled. You've been told that confidence is the goal, that ease is the reward for hard work, that winning proves you've mastered something. None of that is true. Confidence unchecked by vigilance is delusion. Ease unchecked by caution is exposure. Winning unchecked by awareness that conditions are temporary is just the setup for losing. The real measure of a trader isn't how much they make when things are good. It's how little they lose when things turn. It's whether they can recognize when the wind has shifted and adjust before they give back everything they built. If this resonates with you, if you've felt that sickening moment when a winning streak turned into a losing one and you didn't see it coming, if you've ever thought you'd finally figured it out right before the market taught you otherwise, then you understand what I'm trying to tell you. This isn't theory. This is survival. This is the difference between a long career and a short one. This is what separates the professionals who compound wealth over decades from the amateurs who blow up and disappear. I hope this changes how you see the market. I hope it makes you skeptical when things feel easy. I hope it makes you cautious when you're winning. And I hope it saves you from the dark, the mistakes I made and the losses I took before I learned that the most dangerous emotion in speculation isn't fear, it's comfort. If this hit home, leave a comment sharing your experience. Let me know if you've been caught in this trap and what it cost you. And if you found value here, subscribe. I've spent 40 years learning these lessons, most of them the hard way. If I can help you learn them the easier way, that's worth something. I'll see you in the next one.